So let's maybe look at VRT. I'll work for you guys day and night. If you sign up on Godel, I'll look at these stocks all day and night for you, no problem. Oh, these are yummy. These are scrumptious. But let's look at this VRT. Never heard of these guys. Vertiv. Looks like a software company. Vertiv is a global leader in the design, manufacturing, and servicing of critical infrastructure, digital infrastructure for data centers. Spun off of Emerson, probably the most successful SPAC. Critical digital infrastructure technologies and rapidly deployable customized solutions. Hardware, software, and services to facilitate the marketplace of digital systems. AC/DC power management products, there we go. Switchgear and bus bar products, thermal management products, rack systems, modular solutions, management systems for monitoring and controlling digital infrastructure. Okay, so pretty low margin business as you would imagine. Growing like crazy. 5 billion, 6 billion, 7 billion, 3 years. How about cash flow? $200 million, negative 150. 900. So here's the SPAC deal, $10, runs all the way up to 100. Let's retrace a little to 70. Make the model from scratch. So we start with the stock price, right? That you can look up anywhere. I prefer you look it up on Godel, but. Okay, next is shares outstanding. You can look that up on the SEC website. Fastest way to do that is actually through Godel now, since the SEC messed up their site. So you go to the terminal on Godel, which you press the backtick button or the tilde button, which is to the left of your 1 button on your keyboard, and that automatically takes you to the terminal. So if I'm in the chart, I don't know, messing around with the chart, and I want to go to the terminal, I don't have to use the mouse. I could just press this tilde button, tilde, I don't know how to pronounce it, backtick, and it goes to the terminal, the command line, and then I type in the ticker, VRT, type in F8 for equity, this is how Bloomberg works, and I type CF for company filings or Edgar filings, that should say SEC filings, but then I hit enter and they come up. And if I want to go through different components, like I want to close this AMD thing, I don't need this anymore, I just hit escape, again, go back here. CF stands for like company filings. I don't know why Charts doesn't have any kind of terminal system, I don't think. Anyways, let's get back to work. So shares outstanding, that's the second thing I look at after the stock price. And it says that they had 382 million shares outstanding. And that means that if you bought 1 share, right, you own 1 part of 382 million parts. So not a whole lot of the company. It's a very small percentage, 9 zeros. Not 9 zeros, 6 zeros. But let's say you own 100 shares. Can you swing it, 7K, 7 grand? How about 1,000 shares? That's 70K. Ooh, all right, now we're talking big money. Well, that still doesn't even get you 1 basis point, right? Let alone 1%. So let's go to 10,000 shares. That's 700K. That's almost $1 million. Some big money. Still not quite getting you to a single basis point. All right, so now let's do 50,000 shares, or as Kramer used to say, 50. He used to love saying that. Buy 50. Buy 50. Sell 50. Because saying sell 50 sounds like 15, so he says 50. All right, so 50,000 shares is 3.5 million, and that would actually get you 1 basis point for 3.5 million bucks, or 50,000 shares. How about 1%? What about 200,000 shares? That's still basis point territory. We're gonna need millions of shares. Let's do a cool 1,000,000 shares. That's 70 million bucks. You still don't have 1% of the company. Looks like around 5 or 4 million shares. Yeah, 4 million shares, $280 million is for 1% of the company. Well, let's just multiply these two. What if you owned all of the shares? Let's say you owned all of the shares. What would that cost you? 26 billion? Does that sound right? It was much smaller, but the stock has gone up a lot. And that's what we mean when we say market cap, correct? So these guys power data centers, which need this equipment pretty bad. But let's go to the balance sheet. That's the second thing I look at. So the cash is 780 mil. So they don't have much cash compared to the size of the company. And debt, it looks like they have a little bit of debt. But again, not very much compared to the size of the company. So the whole enterprise value is around 29 billion. If you don't understand enterprise value, you probably should go learn about that. I've made many videos on it. But enterprise value is just kind of the difference between the cash position and the market cap. So it's kind of like the market cap's position adjusted for enterprise value. They have a little bit of net debt. All right, what about the actual business? Now that we understand that, how much cash do they have? Almost $1 billion. How much debt do they have? Almost $3 billion. So negative 2 billion in cash, which is 2 billion in debt. So the companies were 27 billion, but they have 2 billion in debt. So you'd have to absorb that debt too if you bought the company. So the total is 29 billion. So now we do the financial statements, the income statement. Income statement is a period statement, so it tells us about what happens the whole period. Balance sheet is a snapshot statement, so it just tells us one period in time. So here's 3 years. And you can see, like I said earlier, they're growing pretty quickly. Revenue jumped from 3.7 billion, jumped 17%, jumped 25%. You don't usually see revenue growth accelerate. That's a second derivative acceleration. What will they do for 2024? Who knows? All right, cost of goods sold, 14,571. Oh, wait. That's product revenue. So they also have services revenue. Okay, so they have product and services. And then this is total revenue. So total revenue increased from 5 billion to 5.7, which is 14%, and then 5.7 to 6.9, which is 21%. Still a second derivative change. So now we're going to look at cost of product, cost of sales, total COGS, product gross margin, services gross margin, and then total gross margin. It's a little convoluted, but it's important. Okay, so product gross margin percentage is 27%, going up to 34%. Services gross margin is higher than product. Interesting, right? And then gross margin percentage, this is the blended gross margin between everything, the whole business is 35%. So pretty low margin business. It sounds like kind of a brick and mortar business, making power supplies. It's like Emerson Electric is a really interesting publicly traded company that was kind of like a GE type of company. They were always like a mini GE to me. And what's great is these guys don't have an AR&D. They have one line, SG&A. Like basically, here's all our operating expenses. And then they have this little, looks like they have this weird other line, which I'll just merge this way. I don't know. I don't particularly like this thing already. But you have to not let your preconceived notions kind of show up. They don't do R&D. I mean, This company just, everything's in SG&A. They don't have R&D. Just make power supplies. There's nothing to research. This might have been the only successful SPAC. What do you guys think? Everyone likes to dunk on 𝗕𝗢𝗢𝗞. Okay, so those are the last 3 years pretty much. Obviously they're growing like crazy. So let's see if we can pinpoint more of that growth a little bit more closely. Let's see here. This is Q2. Whoa, 57% order growth. They're guiding to 7.6, 7.7. 38% margin. They're starting to have better margins than Intel. These guys make power equipment. I mean, I'm sure the stuff is pretty sophisticated equipment if it's running a data center. Well, 13% revenue growth isn't that much. I don't know if they're doing like divestitures or something. Like, let's look at one of what like their equipment looks like. I mean, I think you can probably guess. Data we power and cool. Okay, so a lot of cooling stuff. Liquid cooling, active rear door, passive rear door, row-based cooling, thermal management, power. Let's look at their power stuff. That sounds like maybe their biggest business. DC power, UPS, busway. Okay, interesting. So they're really in the in this world. Let me just buy one of these racks real quick. They don't list prices. What is a KVM though? I'm trying to figure out. Keyboard video monitor, KVM. So basically, if AI and all the stuff kind of continues, like there'll be, and data centers keep getting built out, like this company's revenue will at least go up a lot more. What am I doing? But if that halts to, if that kind of like grinds to a halt, this will be a good short. We don't quite know what'll happen, do we? Will these huge data centers just keep going higher and higher and higher? It certainly seems to have been a great business. But like, I'm not really sure about this like revenue growth. It's like a little sus. Let's keep digging. The valuation's really high. Maybe not though, maybe not. I've only been looking for half an hour or so, right? But yeah, this is like a really good play on the AI boom, if that makes sense. Looking at a company, interesting company I never really heard of called Vertiv. I've seen them every now and then, but I never understood what they do. This helps a lot. Stock market's onto it, I'll say that. Everybody knows this is the pick if you want to be long AI in the market. There's not too many ways to do it. So this is one of the ways to do it. Oh, this is Q2? Did I mess this up? No, I did not. I just didn't do this. Copy pasta. Pretty nice revenue growth here. I mean, you don't see too many companies that do this. This is the revenue growth. It's really solid. This is revenue. Pretty good. Let's go back to the guidance. That's what I want to examine real close now. Okay, so guidance is not that good. 1950. If they do 1950, which is kind of what they're guiding to, revenue growth is like just still 10%, but cloud is growing faster than that. So how could they be growing slower, you know what I mean, than like their customers? I mean, one of the problems with public markets is you don't have access to too many companies. So you kind of like, or you have to sort of deal with the companies that you're kind of like given, if that makes sense. And like, so a lot of people want to play the AI trend. But OpenAI is not public. Character AI just got bought out yesterday by Google. Congratulations to Noam. you know, so you can't buy those companies. So whether it's you or a hedge fund or a mutual fund, so like, you know what, I need an AI play for my portfolio. And this is kind of an AI play, but it's not really an AI play. These guys just make fancy equipment for data centers, massive power, bricks, and you know what I mean? Like stuff like that. 29 billion market cap's a lot, man. Yeah, tech infrastructure, that's it. So like, well, it's data center infrastructure. And data centers are hot right now. They're really hot. Like look at CoreWeave, for example. I'm sure CoreWeave's a customer of theirs. There's only so many companies that can roll out your power, airflow, heating, cooling infrastructure, well, cooling infrastructure. It's not expensive. Not sure it's cheap either. Depends on how fast they grow. I mean, if you really think data centers are going to grow forever, it's not a crazy assumption. So what are they saying there? 57% organic orders growth. What does that mean? Yeah, it's probably long. It's a tricky one though. It's going to be very volatile. If you think we're in a bubble for data centers, like this is the worst stock you could buy. But if you think we're just starting with data centers, this is probably the best stock you could buy. 2% of maturity is very aggressive, yes. And this is roughly the stock price, right? But I think these are conservative assumptions. 10% growth for 5 years and then 1% forever. They're gonna beat that. They're in the data center business. Right now, that's a pretty big business, pretty hot. Cloud is, and these data centers are gonna need more of this type of stuff because like the GPU power is just a little wild. So I like the stock. It's not great. Well, let's see if I pump this up to like 15. That's why I did the 2% maturity. But like in reality, I could probably do like something like that, and you might get a double out of this stock, but it's not like a massive home run. It's kind of priced in, like what the market already kind of saw. Market already kind of saw this. So that's how I feel about that one.